Hi everyone, in this video I am going to share about debt to equity ratio and how to use in fundamental analysis. Welcome to MoneyGuide. Again it's a disclaimer, this video is only for educational purpose. A debt to equity ratio is a financial ratio that measures a company's financial leverage. It shows how much debt a company has compared to its equity. A low DE ratio indicates a company is less risky and uses less debt. A high DE ratio indicates a company may have difficulty covering its debts. A negative debt to equity ratio means a company has more liabilities than assets, which is a sign of financial distress. This can make difficult for the company to get financing or raise capital. A company's DE ratio measures how much debt it has relative to its assets. A high DE ratio indicates that the company is relying too much on debt financing. A negative DE ratio can be a red flag for investors and creditors. When we look financials of the company, different factors plays different roles in helping us to understand its strength of the company. The debt section plays an important role. If a company has zero debt in its balance sheet, then it is known as a debt-free company. Debt plays an important role in the present performance and future growth of any company. These are few companies with zero debt. In simple words, these are called debt-free companies. A debt-free company is said to be an independent company, completely self-reliant without carrying any outstanding loans. Companies with DE ratio 50% or zero point 0.5 is very good. This means it is a low debt business and the company equity is twice as high as its debts. Do you feel the information provided in this video is helpful? Please like, share and subscribe to my channel. Keep learning, keep earning. Thank you.